Hi, this is Elliott Martin,
And I'm Becky Hatfield.
and we're coming to you from opposite ends of the country today to talk about Medicare
We're asking,
and answering all your questions related to Medicare so that way you can make an informed decision. This is the Medicare Navigators Podcast.
Now let's talk about IRMAA. So second Medicare mistake that we need to talk about is what is IRMAA? And if you get a letter in the mail saying that you owe extra, what can you do about it? How can you appeal? Can you kind of explain that whole process?
Yeah, so IRMAA is an acronym that stands for Income Related Monthly Adjustment Amount. So what had happened, I think this was back in 2003, and I need to study up on this history a little bit more. I'm not a history buff, but I think it was the 2003 Congress that passed legislation to means test the Medicare Part B premiums. So before then, I think everybody just paid the same premiums for their Medicare Part B. But Congress said, hey, we need a little bit more funding from those who have the means to afford it. They're going to have to pay more for their Medicare Part B. So higher income earners here in the United States do pay more for Part B. There's about 5 or 6 different income brackets. And maybe what we can do is pull up the brackets on the video here afterwards. But basically, the higher and higher our income goes, the more and more individuals have to pay for Medicare Part B. And that premium, how it's determined is if somebody enrolls into Medicare Part B this year in 2024 or have Part B this year in 2024, Medicare would look at your income from 2 tax years ago, so 2022. So they're always behind a little bit because, it's right now the recording of this video, we're in the month of March. I have not filed my 2023 taxes yet. Okay, so if Medicare can't look, if I were enrolled into Medicare this year, Medicare could not look at my 2023 tax return because it doesn't exist yet. So they've got to go back an extra year to 2022 for this year to determine what I should pay this year for Part B. So that's how it's determined, is they're always in a lag of 2 years. So if we're in 2024, they look at your 2022 tax return. Once we get to January of 2025, they automatically switch to the 2023 tax return. Okay.
Got it.
So here's one of the things that happens is, a lot of times when people are obviously working, they're fully employed, they earn nice incomes. But usually if they're switching to Medicare, it means they're retiring, right? So they're not going to be earning that same high income. So instead, if we just let Medicare do their default thing, if I retire, let's say I retire at the end of this year, if in 2024, really Medicare, and so in 2025, my income is going to be different. It's going to be a lot lower in 2025. Really, Medicare wouldn't adjust my premium to my new retirement income till January of 2027.
Oh, that's a long time to wait.
Right. So you could be paying a higher premium than you need to be for up to 24 months, possibly.
Okay.
So there is a way to appeal it. If you are one of those that have high income now, but as soon as you retire, your income is going to be slashed in half. You're not earning that same amount. You're just taking Social Security and some 401k withdrawals. You can appeal. It's called a life-changing event form. So instead of just letting Medicare do their thing and charging you an extra higher amount for between a year to 2 years, you can have Social Security look at your new retirement income now. You might need to show some proof, submit this life-changing event form, and see if you can get things reduced down immediately, because there is a way to do that. And that can save you a lot of money, especially if we're talking about spouses, where both spouses are having to pay a higher premium. Because if you file joint, they're going off of your joint income. Even if only one spouse is working but at higher income, both spouses have to pay the higher premium. Okay, so that's what I usually suggest for folks is, if you do have the income-related IRMAA charge and you're no longer earning that same income you have been in previous years, check out the life-changing event form and see about submitting that to Social Security.
I'm looking here at the numbers. So we offer anyone who wants it, a cheat sheet with numbers related to Medicare and IRMAA and enrollment periods and all those things. So I'm going to link that below in the show notes. So if you want to download that, you can click the link below.
Cool.
And it'll have all the numbers you need. But just really quickly looking at the numbers right now, if you filed individually in 2022,
Yep.
103,000 or less, then you're just going to pay the normal Part B premium. But if your income is above 103,000 as an individual, you will have to pay extra, or jointly, if it's above 206,000, then you will have to pay extra. So these numbers are important. It's good to know before you get the letter in the mail saying you're going to owe extra, because that would be quite a shock and not a fun letter to get.
No, not a fun letter. And how they calculate that, by the way, Becky, is they look at, so they'll look at your modified adjusted gross income. So if you pull up your tax return, your 1040 federal tax return, it's usually, I think it's line 11, which is your adjusted gross income, plus line 2A. So those two lines on your tax return combined make up your modified adjusted gross income. I think 2A is, tax exempt interest. Usually those amounts aren't huge. Usually it's mostly made up of line 11, your adjusted gross income. So that's the actual number that Medicare, Social Security, and the IRS are going to look at to determine what you should be paying for Part B.
And your gross income is the income that you get before taxes. It's not your net.
Right.
And so even
there are certain, I'm not a tax expert. I think there's some deductions that come off, but it's for the most part, I think it's your modified adjusted gross income.
Okay. So even if you're thinking, oh, my paycheck is this, you have to go to
I don't know if those the FICA taxes are taken out. I don't know how the AGI is calculated off the top of my head. So we'll leave that to the tax professionals.
Yeah, exactly. Someday we need to have just a round table with like an accountant and a CPA and all of the people for all the questions. But we can do insurance. That's what we can do.
Yeah, exactly.
So that's good to know about IRMAA. Let's talk about, what does out-of-pocket exposure mean? And how can people avoid that? I think that's another, I actually have a story about this, and I don't know if you've heard it, but there was this lady I just read about that she was a penny pincher, and she decided she was only going to have Medicare Part A. She didn't even enroll in Medicare Part B. She was like, I'm healthy, I don't need it.
Yeah.
And so, and Medicare Part A is premium free for the most part. And so she just kind of did Part A. She was fine. No Part B, no Part D, no Medicare Supplement, anything. And then she ended up having some strokes and aneurysm. This was in the news. This is how I know about this.
Yeah.
And she had to be taken via ambulance helicopter to the hospital.
Oof.
And sadly, she passed away. But because she was only enrolled in Medicare Part A, her family had to foot the bill for the ambulance helicopter, and the bill was $81,000.
Yeah, that's
some
right.
Exposure right there.
Yeah.
So I think sometimes in an effort for us to want to save some money here or there, which is a total valid desire.
Sure. Yep. Especially in today's economy. Right.
Yes, exactly. And we just think about, what am I paying every month? And that's the only thing we think about.
Right.
But we don't want to leave our families. If something tragic happens and something like this had happened to this woman, we don't want to leave our families. Right. So how do we eliminate that exposure or mitigate that exposure?
Right. Well, one, get enrolled into Part B of Medicare. If you don't have any other employer group insurance and you're 65 or older, make sure you have Part A and Part B at a minimum. Okay, because those two parts of Medicare, when you're using that as your main insurance, that is the brunt of who's going to foot the bill, is Medicare. Okay, these medical expenses, if you've looked at some of the full prices that doctors' offices or surgeons charge versus what the Medicare approved amount is, it is crazy how much they charge, and then the insurance adjustment, cuts that charge down by, I don't know what it is, but seems like it's cut down in a quarter by 20, by 75% reduced. So when it comes to having Medicare Part A and Part B, that is going to be most of your coverage, right? So for example, on Part B of Medicare for outpatient services, if you need chemotherapy, a surgery, radiation, things like that, things that are very expensive, MRIs, Medicare is going to pay, Part B is going to pay 80%. So that is nice, right? It picks up majority of those expenses, but it still leaves you on the hook for 20%. Okay. And if you just have Part A and Part B of Medicare, and you do have that type of outpatient service, the 20% responsibility has no limit to the out-of-pocket amount. There's no out-of-pocket maximum on Part B of Medicare. So the example I like to use, I always talk about this in the webinars I give, the Medicare 101s, it's my dad. My dad has shoulder problems. He's got bone on bone in his shoulder. He played football in high school. And get this, his nickname was Nails at Sherman Oaks High School, or Notre Dame High School in Sherman Oaks. And I never believed my dad that his nickname was Nails until one day I pulled out, I was looking through some of the boxes in the garage, and I pulled out a newspaper article that said Raymond Sr., led by Senior Raymond Nails Martin. And I could not believe it. I was like, wow, he was not lying. But so anyway, my dad's got a ton of sports injuries, back injury, shoulder injury. And then on top of that, me and my brothers, we were all baseball players. So my dad would hit us thousands of pop flies at the park, but he would swing the baseball bat, he'd throw the ball up and then hit the baseball with one arm. He'd swing the bat with one arm. And so my dad's just got all sorts of issues going on with his shoulder. So what is he doing? He's going to the doctor. He's been referred to specialists. I think he's seen multiple specialists. He might have already gotten an MRI, and someday he may need surgery to go in there and fix things up in the shoulder, and then he'll need physical therapy, follow-up visits, follow-up MRIs and x-rays. If he just had Medicare and that's it, he would be responsible for 20%, 20%, 20%, 20% for everything with no cap. So even though Medicare does pick up a majority of those expenses, we're still paying 20%. So it's really important. What we always suggest for folks is add on some sort of Medicare supplement plan to pay for that 20%, or join an Advantage plan. The Advantage plans will kind of put a cap on your out-of-pocket exposure. Maybe you don't have as much freedom of choice and access to doctors, but you at least put a cap on your out-of-pocket exposure. So at a minimum, have Part A and Part B, but don't just stop there. Add on something else to help eliminate that type of out-of-pocket exposure, because really that's what we need to avoid. That's the type of expense that can really derail and bankrupt us, right? If we had to pay, if that lady lived through that traumatic experience and she had to pay $81,000, where's that money going to come from, right? Her retirement, if she's got some money put away for retirement or in savings, I mean, that can put a damper in your retirement, right? So it's really important, work with the fixed costs, what works with your monthly fixed budget. But, we want to make sure and eliminate that kind of catastrophic expense from potentially happening. That's the main thing, especially when we're in retirement. We're counting on this money to last us the next 15, 20, 30 years. For some people, if you're planning on living into your 90s and 100s, that money's got to last a long time. And it's got to keep up with inflation. There's a ton of other things we can talk about as far as retirement planning, but we want to eliminate those medical expense possibilities, those large things, the $50,000, $60,000, $70,000, $80,000 charges. We want some insurance company to pay that instead. Okay. So that's part of the game, is we got to pay a monthly fee to get that type of catastrophic coverage. So
I gotcha. And so, yes. And I think too, there's certain types of insurance that you think, okay, I could pay this much every month for that type of insurance, but that thing, whatever it might be, is probably never going to happen.
Yeah.
But as we get older, it's pretty definite that our health is not going to stay the same. It's going to decline as time goes on. And
Right.
so it's a pretty safe thing to plan on negative things happening to our bodies.
Yeah.
And
It's hard
it's
to
not going to
admit,
be
right?
money wasted. Yeah, it's not going to
Yeah.
be money wasted.
Right. None of us are making it out of here alive, right? That's the reality, right? So whether we, if we all go in our sleep peacefully, great, but that's not going to, statistically speaking, that's not going to happen to everybody, right? Where, a lot of folks deteriorate and they've got, medical things coming up, and they can come on pretty quick too, right? So we can be healthy, and then all of a sudden we have a slip and a fall. We get admitted to the hospital. We contract pneumonia at the hospital. Things can happen very quick. So it's just best to be prepared. Of course, you want to make sure you're getting the most cost effective, the best bang for your buck when it comes to insurance, though, right? We don't want to be overpaying. We don't want the insurance companies taking advantage of us, but we still want to make sure we're properly covered. So just finding that in between. One last thing, especially in what you brought up, for family, right? Right now, hopefully everybody watching this is independent. You're taking care of things on your own, but over time, we have to rely on family members to help us out. And the type of stress that that family members are going to have to go through to help care for you. I mean, I talk to children that are taking care of their parents all the time, their elderly parents, and just the amount of stress that they go through, having to figure out where, okay, do we move mom or dad? Do we move them into a facility? Do we move them in with me? Where do we move them? Who's going to watch them? Who's going to take care of them? Who's going to tend to them when they need, if they can't get up? That's all sorts of things, stresses. So it's, to have a financial stress on top of that as well, or a big bill that we're responsible for. I mean, if we can take care of that, that's why having some sort of extra insurance really can come in as well as a benefit.
Yes, it protects your legacy for your family too.
Absolutely.
So if you have plans to leave an inheritance or just make your kids' lives easier, then having that extra insurance kind of protects those wishes, because then you can make sure that they're, first of all, not having to pay your bills after you pass. And then also, if you don't want them to have to take care of you, if you want to kind of free them to live up their lives or whatever, then those things can help with that.
Thank you so much for joining us for another episode of the Medicare Navigators podcast. We have a weekly Medicare 101 webinar that we would love to have you join us on. Go to our website at www.martinmedicare.com to reserve your spot today. Please join us again next week as we continue this conversation. All information related to this episode is listed below in the show notes.